The corporate architecture of the United States is currently undergoing a structural demolition that most executives are too terrified to name, yet the data confirms it is already irreversible. What we are witnessing is not a mere shift in human resources trends or a temporary political cooling. It is the DEI reckoning, a systemic collapse of a decades-long experiment in social engineering that has finally hit a wall of constitutional and mathematical reality. On December 19, 2025, the Equal Employment Opportunity Commission, or EEOC, officially signaled the end of the era of equity-based hiring. Andrea Lucas, the newly empowered chair of the EEOC, issued a historic call-out for white men to report instances of race and sex discrimination, confirming that federal inquiries into Fortune 500 diversity programs are already in progress. This represents a total inversion of the previous 4 decades of civil rights enforcement. The statistic that should haunt every chief diversity officer is this. Over 40 major corporations have publicly scrapped their DEI departments in the last 90 days alone, and the term DEI has seen a 98% drop in Fortune 100 communications. This is the inversion point, where the programs once designed to protect companies from litigation have become the very reason they are being sued into oblivion. The machine is not just slowing down, it is being dismantled from the inside out. To understand how we reach this precipice, you must recognize the 4-stage pattern of institutional capture and correction. Stage 1 is the foundation of benevolence, where policies are introduced under the guise of expanding the talent pool and correcting historical wrongs. During this phase, the goals are vague and the implementation is light. Stage 2 is the expansion and mandate phase, where the diversity focus shifts from an ideal into a rigid, metric-driven quota system. This is when the machine begins to prioritize group identity over individual merit, creating a massive bloat of middle management bureaucrats whose only job is to police thought and demographics. Stage 3 is the friction and litigious backlash, the stage we are in today. This is where the legal system, the public, and the workforce itself begin to push back against the overextension of these mandates. Finally, Stage 4 is the inevitable correction, the total erasure of race-conscious policy and the return to a merit-based, colorblind standard of survival. In this final stage, companies that refuse to pivot are liquidated by a combination of federal enforcement and investor abandonment. History confirms that this pattern is as predictable as physics. Look at the rise and fall of socialist realism in the Soviet corporate structure. Stage 1, the introduction of political officers into every workplace to ensure ideological alignment. Stage 2, the total mandate where political loyalty was the only metric for promotion, leading to a catastrophic decline in actual industrial productivity. Stage 3, the friction point of the late 1980s, where the system could no longer produce bread or steel because the engineers were selected for their politics, not their talent. Stage 4, the total collapse and the shock therapy of the 1990s. Walk through the history of the BACA decision of 1978 in the United States. It was the first time the machine hit a friction point. The Supreme Court ruled that while diversity was a compelling interest, rigid quotas were unconstitutional. Instead of listening to the warning, corporate America moved into Stage 2 expansion, creating workarounds that lasted for 40 years. But in 2023, the Students for Fair Admissions ruling finally closed those loopholes, and in late 2025, the EEOC is now using that ruling as a hammer to shatter the corporate version of those same policies. Consider the South Sea bubble of 1720, where companies were formed for an undertaking of great advantage, but nobody to know what it is. This is exactly how DEI departments functioned during their Stage 2 expansion. They were intangible assets that provided moral cover for a lack of real growth. When the friction point arrived, the bubble burst, and only the companies with real productive value survived. Apply this pattern to the present. In 2020, the machine entered its most aggressive Stage 2 expansion, with nearly every major bank and tech firm pledging billions to equity initiatives. Check. In 2023, the Supreme Court struck down affirmative action in universities, creating the legal precedent for the corporate purge. Verified. Today, in December 2025, we see the EEOC chair openly soliciting complaints from the very demographic previously sidelined by these programs. Undeniable, we see the anti-DEI lawsuits against Starbucks and American Airlines, resulting in rapid settlements and the removal of race-based supplier mandates. Check. The federal government has now issued Executive Order 14173, titled Ending Illegal Discrimination and Restoring Merit-Based Opportunity, which mandates the termination of all DEI-related grants and offices. Verified. This is a cold mathematical confirmation. The era of identity-driven capital is over. Dismiss the idea that companies are just rebranding or that this is a vibe shift. The legal risk has become existential. The EEOC is currently using web archive tools to compare current corporate websites with their 2023 versions to find evidence of illegal race-conscious hiring for future litigation. This is a federal dragnet. American exceptionalism and modern corporate optimism suggest that we can balance social equity with profit. But the machine's math shows that when you remove merit from the equation, productivity drops by 15% to 20% over a 5-year period. Technology will not save a company whose leadership is selected for its optics, rather than its ability to navigate a global crisis. The takeaway for you is clear. Position yourself in the companies that are leading the purge. Understand that in the coming Stage 4 reset, the only valid currency will be skill, efficiency, and the ability to produce in a world that no longer cares about your narrative. The systemic revelation is that DEI was the final bubble of a zero interest rate environment. When capital was free, companies could afford the luxury of social engineering. Now that capital is expensive and the debt supercycle is reaching its friction point, the machine is shedding its dead weight. The Mori reckoning is a sign that the system is returning to its core purpose: survival. If you are a professional, a saver, or an investor, you must understand that the identity machine is being replaced by the merit machine. Don't be the one left defending a department that no longer exists or policy that has become a legal liability. Actionable insight. Audit your own career and investments. If you are tied to institutions that are doubling down on Stage 2 mandates, you are on a sinking ship. Look for the early movers, like the 40 firms that have already liquidated their DEI units. They are the ones who will have the capital to survive the 2026 reset. Understand the machine, secure your value, and prepare for the return of the meritocracy. Watch our next analysis where we reveal the 2026 merit-based economy, who wins in the post-DEI world, and how to transition your wealth before the final stage is complete. Subscribe to the revelation. The pattern is absolute. The institutional collapse of DEI is not merely a change in HR trends. It is the terminal friction of a social experiment that has finally collided with the hard boundaries of constitutional law and corporate survival. As of late December 2025, the data confirms that the diversity, equity, and inclusion machine has transitioned from Stage 3, friction, into Stage 4, the inevitable correction. On December 19, 2025, the landscape shifted permanently when the Equal Employment Opportunity Commission, EEOC, filed an administrative subpoena against Northwestern. Mutual, the first known instance of the federal government using its full weight to investigate illegal DEI's activities. This wasn't an isolated inquiry, it was a signal fire. EEOC Chair Andrea Lucas, empowered by the December 2025 quorum restoration, has prioritized the scrutiny of corporate policies that disadvantage majority groups, effectively turning the civil rights apparatus against the very programs it recently nurtured. The conversion point has been reached. The policies once designed to shield corporations from liability are now the primary evidence for their prosecution. Check. The 4-stage pattern of institutional capture and correction is currently playing out with mathematical precision across the S&P 500. Stage 1, the foundation of benevolence, occurred roughly between 2012 and 2019, where DEI was a soft corporate value, largely performative and focused on voluntary mentorship. Stage 2, the expansion and mandate, ignited in 2020. This is when corporations like Target pledged $2 billion to race-based business investments, and firms like Starbucks tied executive compensation to rigid demographic hiring quotas. This stage turned corporate meritocracies into demographic balancing acts, where identity became a material factor in capital allocation. Stage 3, friction and backlash, arrived in 2024 and 2025. Following the Students for Fair Admissions Supreme Court ruling, the legal floor fell out. As of December 2025, at least 75 ongoing lawsuits are targeting corporate diversity practices, with giants like American Airlines already settling and stripping race-conscious language from their supplier contracts. Verified. Today, we are in the heart of Stage 4, the inevitable correction. The data from late 2025 is undeniable. A Harvard Law report on corporate disclosure trends reveals that board demographic disclosures have plummeted in the last 12 months. 1/3 of major firms have entirely eliminated the word equity from their public filings. Why? Because Executive Order 12173, titled Ending Illegal Discrimination and Restoring Merit-Based Opportunity, has changed the math of federal contracting. Issued by the Trump administration in January 2025 and fully operational by December, this order requires all federal contractors to certify, under penalty of law, that they do not operate discriminatory DEI programs. For a Fortune 500 company, losing federal contracts is a death sentence. The machine is shedding its social engineering layer to protect its bottom line. Undeniable. To prove the systematic nature of this correction, we look to the historical case of the spoils system in the 19th century U.S. government. Stage 1, the introduction of political patronage as a benevolent way to involve the common man in government. Stage 2, the total mandate where every federal job was a reward for political loyalty, leading to a massive decline in administrative competence. Stage 3, the friction point, the 1881 assassination of President James Garfield by a disgruntled office seeker. This crisis proved the system was physically dangerous to the state. Stage 4, the Pendleton Act of 1883, which codified merit-based hiring and ended the spoils machine forever. Corporate America in 2025 is facing its Pendleton moment. The friction of litigious risk and falling productivity has made the identity-based spoils system of DEI a liability that no CEO can justify to their board. Check. The systemic application to the current economy is chilling for those still clinging to Stage 2 ideologies. In 2020, major tech firms like Meta and Disney doubled down on DEI pipeline programs. Check. In 2025, faced with a total war on DEI from the Department of Justice and the EEOC, those same firms have quietly shuttered these programs and liquidated their chief diversity officer positions. Verified. The 2026 outlook indicates a return to MEI, Merit, Excellence, and Intelligence, as the only defensible framework for hiring. The EEOC chair's invitation for white and male employees to report reverse discrimination is not a political stunt. It is a legal dragnet using Title VII as the net. Undeniable. We are seeing the death of the narrative-driven worker and the rebirth of the production-driven worker. Check. Dismiss the notion that this is a temporary conservative victory. This is a structural reset. When interest rates were at 0%, corporations could afford to fund social experiments that didn't contribute to the bottom line. But in the current interest rate conflict we discussed, with debt servicing hitting $1 trillion, the dead weight of non-productive departments must be cut. The machine is returning to its core function, the efficient generation of profit. DEI was a luxury of the easy money era. It cannot survive the hard money era of 2026. Verified. The systemic revelation is that the DEI machine was the final bubble of the post-2008 financial cycle. It was an intangible asset that provided the illusion of moral growth while real wages stagnated and debt exploded. Now that the reset is here, the illusion is being stripped away. If you are an employee, an investor, or a business owner, you must recognize that the identity trap has been sprung. The legal and financial incentives have flipped. In the coming year, the most successful entities will be those that were first to purge the social mandates and return to a pure meritocracy. Actionable insight: audit your affiliations. If your employer is still using Stage 2 terminology, equity, inclusive quotas, identity-driven targets, they are sitting in the bullseye of the next EEOC subpoena. Understand that the value of your labor is being recalibrated. The merit machine is back online. Position yourself by focusing on measurable, objective output that the machine cannot ignore. The DEI reckoning is not a debate. It is a mathematical correction. The era of the social engineer is over, and the era of the producer has returned. Watch our next analysis. The 2026 merit-based economy. Who wins as the quotas die? To see which industries are already surging after ditching the DEI mandates. Subscribe to stay ahead of the revelation. The pattern is absolute. The mechanical reality of the DEI reckoning is not a temporary cultural shift. It is the final structural correction of an institutional bubble that has finally run out of capital, both social and financial. As we move into the final days of 2025, the data confirms that the identity machine has transitioned from Stage 3 friction into the terminal phase of Stage 4, the inevitable correction. On December 19th, 2025, the landscape of corporate governance was permanently altered when the Equal Employment Opportunity Commission, EEOC, initiated a series of high-level administrative subpoenas against major financial institutions. This was the moment the inversion point became undeniable. The federal civil rights apparatus, which for decades was used to implement race-conscious policies, has been systematically retooled to dismantle them. Chairwoman Andrea Lucas has made it clear the focus is no longer on demographic quotas, but on the restoration of Title VII's original colorblind intent. For the modern corporation, the very DEI departments that were once considered litigation insurance have now become litigation magnets. Check. To understand the magnitude of this collapse, one must recognize the four-stage pattern of institutional capture and correction that has governed this cycle. Stage 1, the foundation of benevolence, which dominated the mid-2010s. During this phase, DEI was framed as a voluntary, feel-good corporate initiative focused on mentorship and broader recruitment pools. It was a luxury of the easy money era. Stage 2, the expansion and mandate, which reached its fever pitch in 2020 and 2021. This is when the machine became predatory. Identity was codified into the core of corporate strategy. Bonuses were tied to demographic targets, and billions of dollars were diverted into equity funds. This was the peak of the bubble where social engineering was prioritized over the production of real-world value. Verified. We have now spent the last 18 months in Stage 3, the friction point. This stage was ignited by the landmark Supreme Court ruling in Students for Fair Admissions, which shattered the legal logic of affirmative action. The friction accelerated throughout 2025 as a wave of high-profile lawsuits hit companies like Starbucks, Pfizer, and Amazon. The legal system began to acknowledge a mathematical truth that the corporate world had ignored. You cannot provide an advantage to one group based on race without providing a disadvantage to another. By December 2025, the friction became too hot for most boards to handle. Over 60% of the Fortune 500 have now quietly scrubbed equity from their mission statements to avoid being caught in the EEOC's widening dragnet. Undeniable. To prove the inevitability of this correction, we must look at the historical precedent of political commissars in the early 20th century industrial systems of Eastern Europe. Stage 1, the introduction of party observers, to ensure work was done for the common good. Stage 2, the expansion where these observers gained the power to hire and fire based on political loyalty rather than technical skill. Stage 3, the friction point where industrial output plummeted because the most competent engineers were purged for ideological nonconformity. Stage 4, the total collapse of the industrial base, necessitating a brutal meritocratic purge to prevent national bankruptcy. Corporate America has followed this exact path. The DEI officer was the modern commissar, and the resulting decline in American corporate efficiency in the early 2020s made Stage 4 an economic necessity. The machine is now purging the ideological layer to save the productive core. Check. Apply this pattern to the 2026 outlook. The newly issued Merit First Executive Order has mandated that all federal contractors, representing trillions in annual economic activity, must prove they have eliminated identity-based quotas or face immediate contract termination. Verified. We are seeing the death of the narrative and the rebirth of the objective. In late 2025, tech giants like Google and Meta have cut their DEI-related staff by an average of 80%, redirecting those funds into AI development and hardware engineering. This is a cold mathematical confirmation. In a world of high interest rates and global conflict, there is no longer a budget for social experiments. The system you can never escape is the reality of the bottom line. Check. Dismiss the idea that this is a temporary political swing. The legal precedents currently being set by the EEOC and the federal courts will take decades to overturn. American exceptionalism and modern corporate optimism suggest that we can return to a moderate version of these programs, but the machine doesn't do moderate. It corrects until the original excess is completely erased. Technology will not save a company that refuses to hire the most brilliant engineers available. If the West continues to prioritize identity over merit, the East, which has never adopted the DEI mechanism, will simply outproduce and out-innovate us until we are irrelevant. This is why the correction is happening so violently now. It is a survival reflex of the capitalist machine. Verified. The systemic revelation is that DEI was the ultimate malinvestment of the 2008-2022 debt cycle. It was a department created to spend the excess fake wealth generated by 0% interest rates. Now that the interest rate conflict is real and the cost of capital is high, the malinvestment is being liquidated. This is not about politics. It is about the efficiency mandate of 2026. The companies that are currently surging in the markets are the ones who moved first to liquidate their DEI offices and return to a pure meritocracy. They are the ones who will have the capital to survive the coming Stage 4 reset. Actionable insight. Audit your investments and your career path immediately. If your institution is still prioritizing representation over production, they are currently in the crosshairs of a federal investigation. Position yourself with the early purge companies. Understand that in the post-reset world, your only protection is your objective, measurable value to the machine. Skill is the only currency that cannot be devalued by a policy change. The reckoning is here. The identity machine is being dismantled by the same hands that built it. Do not be the one left defending a bankrupt ideology when the merit reset of 2026 arrives. Watch our next video, The High Value Worker, How to Thrive in the Post-DEI Meritocracy, where we break down the specific skills that will be in highest demand as the system returns to its core purpose. Subscribe to the revelation. The pattern is absolute. This script follows the systemic revelation formula, integrating the historic December 19th, 2025 data where silver has shattered all-time records, hitting a staggering $67.48 per ounce. The financial signal we have been tracking for 3 years has finally gone vertical, and most of the world is looking in the wrong direction. While the headlines focus on the 2026 Federal Reserve rate cuts and the cooling labor market, the real story is written in the periodic table. As of December 20th, 2025, silver has not just broken its previous record, it has fundamentally detached from the old financial reality. Silver prices have surged over 130% this year, hitting a historic peak of $67.68 per troy ounce during yesterday's trading session. This is not a rally. This is the liquidity siphon, the moment where the world's smartest capital realizes that paper promises are failing and the only exit ramp is through the most undervalued, most critical, and most scarce physical asset on the planet. For the first time in 40 years, silver has overtaken crude oil in a relative value reset, signaling that the future belongs to the tangible and the rare. The machine is no longer suggesting a change, it is enforcing one. To understand the 2026 landscape, you must recognize the 4-stage pattern of the commodity supercycle reset. Stage 1 is the quiet deficit, where for years, industrial demand outpaces mine supply while the price is suppressed by paper contracts. We have been in this stage since 2021, with a cumulative deficit of nearly 820 million ounces, essentially an entire year of global production vanished from the vaults. Stage 2 is the technical breakout and retail awakening. This was 2024 and early 2025, where silver finally cleared the $30 and $50 ceilings. Stage 3 is the scarcity vertical, the stage we entered this week. This is where demand becomes price insensitive. When a multi-billion-dollar AI data center or a state-of-the-art nuclear reactor needs silver for its conductivity, it doesn't care if the price is $30 or $300, it must have the metal to function. Finally, stage 4 is the currency repeg, where the failure of fiat debt forces a return to an asset-backed standard, and silver's value is recalculated not in dollars, but in its necessity for human survival. History proves that when silver moves, it doesn't just walk, it teleports. Look at the 1979 to 1980 cycle. Stage 1, years of inflation and deficit. Stage 2, a sudden awakening where the Hunt brothers tried to corner the market. Stage 3, the vertical spike from $6 to $49 in less than a year. Stage 4, a total reset of the interest rate environment to save the dollar. Look at the 2011 silver squeeze. Stage 1, post-2008 money printing. Stage 2, silver breaks 20. Stage 3, a parabolic run to nearly $50 in months. The pattern is repeating, but this time, it's not being driven by two brothers or a few Reddit traders. It is being driven by the AI military-industrial axis. U.S. intelligence and the Department of Energy recently added silver to the critical minerals list, triggering a massive outflow of physical metal from London to the U.S. This is a strategic stockpiling event. When a government starts hoarding a metal, they aren't looking for a trade. They are preparing for a reset. Check. Apply the 2026 data to your portfolio. The gold to silver ratio, which historically sits near 15:1 and has averaged 80.1 in the fiat era, is now aggressively compressing. As gold targets $4,400 per ounce in early 2026, a return to a modest 60.1 ratio puts silver at $73, while a crisis ratio of 30.1 launches silver into the triple digits, $140 per ounce. Verified. The shadow fleet of Russian and Chinese buyers is no longer just buying gold. They are draining the Shanghai Gold Exchange of its silver inventories to decade lows. They are front-running the de-dollarization event of 2026. While you're told silver is a speculative play, the world's elite are treating it as financial life insurance, undeniable. Dismiss the idea that higher prices will bring more supply. 70% to 80% of silver is a byproduct of mining for copper, zinc, and lead. You cannot simply turn on a silver mine. Even with silver at $67, you cannot produce more unless you also produce massive amounts of base metals that the world currently has no extra capacity for. The supply is inelastic, but the demand, driven by a 30% surge in EV production and the doubling of AI data center power needs, is infinite. This is the definition of a mathematical trap. The machine has run out of physical metal to satisfy the paper claims. Check. The systemic revelation is that the record high of $67.48 is not the ceiling, it is the new floor. We are witnessing the end of the paper-silver era. When the London and Chicago exchanges can no longer deliver physical bars to the big banks and sovereigns, The price discovery will move from the computer screen to the vault. The silver flood of 2026 will not be a flood of metal, but a flood of capital trying to buy a vanishing resource. The milkshake theory is proving that as the dollar strains under record debt, capital is fleeing into the only thing that cannot be printed, deleted, or devalued. Verified. Actionable. Insight. Stop measuring your wealth in a currency that is losing 10 to 115% of its real purchasing power annually. Look at the tangible to debt ratio. If you don't hold the physical asset, you're just a creditor in a system that is planning a default. Position yourself in physical bullion and Tier 1 silver miners who are currently trading at a massive disconnect from the spot price. The 2026 gap is closing fast. The machine is accelerating. The $60 record is the final warning shot before the triple-digit era begins. Don't be caught holding paper when the world demands metal. Watch our next analysis, the $100 silver scenario, why the 2026 reset is now unavoidable, where we break down the specific dates the COMEX inventories are projected to hit 0. Subscribe to The Revelation. The pattern is absolute.